Hello, chart watchers, and welcome to this Wednesday, September 4th, 2019 Market Watchers live show with your host, Erin Swenlin. We are glad that you are joining us. If you are here for the first time, welcome to the show. And for our regulars, of course, welcome back. Let's go ahead and see what is going on in the markets currently. And here we go. All right, well, as you can see, market's up right now, looking a little bit better than it did yesterday, that is for sure, but we haven't made up all of the losses really from yesterday. And so at this point, you can see gaps up on the Dow, the S&P 500, and as well the NASDAQ. NYSE, same. It has managed to get above its previous high back from August 30th on Friday. And then we can see TSX made a nice bump to the upside, is pulling back. The Canadian markets, we'll see if they can restart here, maybe at this area that could be support here at 16,450. Russell 2000 also up 9.44 points. Treasury yields are currently up slightly, 1.471%. The VIX is falling. We're seeing a reading right now of 17.77. UUP gap down, moving sideways right now, down a little over 0.5%. Gold, GLD, is moving mostly sideways, but we are seeing some upside movement, up 16 cents for GLD. USO, nice big move to the upside, big gap up on the open and continuing higher, trying to reach those highs that we saw back on last Thursday. TLT moved to the downside, but it does look like it wants to get up there back into positive territory, but it is reading at 147.03. All right. Well, it's great to be back. I was gone yesterday. And Tom, for those of you wondering where he is out still, but he will be back next week. And, well, I have someone very special here. Linda Raschke is with us. So she's sort of my co-host today. How's everything going for you?
Excellent. Excellent. Thank you so much for having me back on. It's always an honor to be on a platform where I have so many respected colleagues that also, give you presentations.
Yes, it's really great to have a fellow technical analyst here as well. So what are you thinking about the markets right now? You know, everything's starting to move to the upside.
I was thinking that today I would sort of go over my top-down basic summary in 15 minutes that will give you a structure by which you can put things into context, assess the current market environment. And when you want me to do my dog and pony show, let me know.
I absolutely will. I know that you recently published a book. Do you want to tell everybody about that a little bit before we start?
Oh, yeah, absolutely. It's called Trading Sardines, and it essentially sums up my 40 years, actually 39 years, in the markets of all the wisdom I learned from colleagues who, a few of whom have left us, and just mostly technical. Lots of stories of outlier events and how we managed them for my CTA fund. Lots of humor, and it was my way of documenting all these wonderful stories and tips I learned from people like Mike Epstein, Ned Davis, just so many people that I have the world's greatest respect for. So it's a low-priced book. It's a hardcover. It's not available on Amazon. It's only available on my website, lindarashke.net.
All right.
You can go there and read the first chapter.
Absolutely. And I did read it and I thought it was fabulous. I don't know that a lot of the women out there, the financial investors out there watching the program know, but I would say you clearly were the one who broke the glass ceiling for most women in the business.
Oh, thank you. But, I think there's also a lot of other fund managers and people in the business well before me, Muriel Siepert, obviously, Gail Dudak in terms of the technical side. And Liz Chabal was somebody who was one of the original turtles who actually started her CTA before I did. And sadly, she's passed as well. But, I think there's more of us out there than people realize. We just tend to keep a low profile.
Yes, I think you're right about that. That's probably correct. All right, well, I will bring you back for your show here, your dog and pony show, as you were saying, shortly. But I'm going to go ahead and start off with looking at our agenda and some technical news. So, upcoming tomorrow, Bruce Fraser is going to join me as guest co-host. On Friday, of course, Mary Ellen McGonigal will be in to do What's Hot, What's Not. At this point, we're believing that Tom will be back from jury duty on Monday of next week. Tuesday, I'm going to be doing a workshop. I have seen some survey comments about setting stops and figuring out your resistance and making a trading plan. So I think I will do that workshop on that. David Keller will be here to join us on Wednesday of September 11th. So a great schedule coming up. And today I did introduce Linda, and she is going to be talking to us about analyzing the market environments out there and how you can do that, and also giving us a look at what she's seeing at this point. 10 and 10. Our first symbol will be Micron Technologies, MU. So if you want to go take a peek at those, at that chart before I do the 10 and 10, feel free. All right, so I'm going to get started right now with some technical news and headlines. All right, so we'll go ahead and first off, there were no economic reports today, but we did see some earnings that were released, and I can find that for you over here. Plus, I think my producer is going to show you the slide. I took the screen a little too soon, didn't I, Zach? All right. So for earnings, there you go. American Eagle Outfitters reported they had a nice beat, but they are down right now. Michaels, they reported 19 cents versus 14 cents, so another beat. Navistar, $1.47 versus $1.12, which was expected. And then we do have a couple of important earnings that are going to be released after the market close, including Cloudera and Pivotal Software, among others. So you'll probably want to take a peek at those. I'm going to go ahead and we're going to move into looking at a market summary here. This you can get to from our dashboard. In fact, I'm going to show you how to do that right now. So if you go from your dashboard, you can go over here, and under reports and analysis tools, you can find the market summary, and you can view it in the chart view and in the table view. I'm going to go ahead and look at it in table format, and this is going to tell us which of the markets are doing the best, which are failing, what is going on as far as the industry groups. So as you can see right now, we're seeing the NASDAQ is one of the leaders at a percent change of over 1%. S&P 500 is climbing though, so we might be seeing an over 1% to the upside move shortly. And when I go down and look at some of these major indexes, the transports are showing some strength today. Dow theory tells us that that's a good thing. If the transports start doing well, we should expect the markets of the Dow to start doing well. So watching that very closely, NASDAQ 100, we're starting to see some of those large cap technology stocks getting somewhat of a boost right now, also up a little over 1%. And then if I go down here and look at the sector spiders, and do take our poll that we put in there, it's asking about the defensive sectors and whether you believe that they are going to be, they're going to continue to be the leaders. Right now, though, as of today, comm services are leading at this point, up over 1.5%. Technology also leading. So we've got two fairly aggressive sectors here for sure, technology, that are leading right now. So that does usually bode well for the market when you want to see those rallies coming off of those aggressive sectors. When you see those defensive sectors leading, that usually means that there might be a little bit of trouble ahead. It's not where you want to find the strength in the markets. As far as the industry groups go, disk disk drives and semiconductors are the leaders right now, and hardware, all of those up over 2%. So we're seeing a nice move again in those technology industries. That's where we want to see some strength. As far as the laggards go, biotech's really taking it on the chin today, down almost 1%. Drugs, healthcare, we're seeing all of these industries starting to fail here. I noticed also gold is near the bottom of this list, the XAU. It is up slightly, but I'm paying a lot of attention also to metals right now. I'm going to go ahead, in fact, move over and show you some of the charts that I think you need to be looking at right now from the Decision Point Live chart list. All right, and then I will show you some upgrades and downgrades. I do go over these charts with my dad on the Decision Point show, which is now airing on Mondays. So you'll look for us next week on Monday. But I do talk about pretty much all of these charts that I'm going to show you. I think they're important for you to note and to see. So this is a relative chart, and it's showing you the prices relative to the S&P 500 of all of these major groups. And really the thing I think that is important to see is the fact that the S&P 400 and the S&P 600, your mid and small caps, continue to underperform. We've been watching the S&P 600 staying at relative lows that we haven't seen in quite some time. And we do need to see, just like we want to see those aggressive sectors start to perk up, we also want to see the small caps starting to perk up as well. And we just have not seen that. So that is something to keep an eye on and to watch for. Then I wanted to show you just the broad market indexes and what's going on all on one chart, which is something I like. Notice we are sitting up here really bumping our heads against overhead resistance here for the SPY. So we want to see that breakout. It concerns me that I'm seeing these rising bottoms, but we're hitting that overhead resistance. We haven't quite been able to pop up above it. However, that is a bullish chart pattern. You are looking at an ascending triangle there. And so we want to see that breakout to the upside. We're supposed to expect a breakout to the upside. So I think we're in some pretty important, a pretty important area here that we need to watch and really see a nice decisive breakout here. Decisive being 2.5% to 3%. The equal weight we can see is really not come up to challenge those highs, looking very similar to the S&P 500. And here you go. These are those two lagging indexes, the mid caps and the small caps. And that is the problem that we're having right now, that they're not reaching up toward their all-time highs. In fact, the margin between the all-time highs and where they are currently trading at, big problem, huge margin. We need to see that made up just a little bit. All right, I'm going to look at a few upgrades and downgrades. And here we go. The first one I wanted to look at was Abercrombie. Abercrombie was, Abercrombie was upgraded today from an underperform to a peer perform. I'm not really sold on the upgrade here, and here's why. If I bring this out, you can see we've dropped below some pretty important support from that late quarter in 2018, as well as in June. We popped down below that. I guess they're looking for it to make a move up higher at this point because we're sitting at these tops back here. But I also see a gap that hasn't been covered yet. So I think there's certainly a good possibility we could see things move lower. Look at that PMO heading down and in negative territory, top below the signal line. There's nothing here I like as far as upgrading. And then the last one I'm going to show you is Kimco Realty, and this one was downgraded by Compass Point from a neutral to a sell. They've moved their target to 1775. So let's get that in here. And that, I'm guessing, is going to line up, yep, right there at the lows that we were seeing here back in June, July. So they're looking for a drop back down there. But you know, for me, when I look at this pattern right now, we're getting a pretty nice breakout. This also is in that REITs category. And you know, we're we're seeing that resurgence. And if we do continue to see interest rates move lower, there's a very good chance that we're going to see this one continue higher. So I didn't agree with the upgrade on Abercrombie, and I don't agree with the downgrade on Kimco at this point. Notice the PMO even. I mean, we're looking at a turn above the zero line and moving up, nice momentum, and even the OBV you can see right here, nice rising bottoms confirming that move to the upside. So not sure what's going on there, but at this point, I would say with that downgrade, not so good. All right, so there you go, upgrades and downgrades. We will be right back with Linda Raschke, so you want to stay tuned. We are back with Linda Raschke, our very special guest today. And great to have you here, Linda. I know you have a lot to show us and tell our audience. So I'm just going to pass it over to you here as you get your charts up there and ready. But I did get a sneak peek, and I have to say, I did notice that some of those were decision point charts.
You know, I've been a long time user of these charts, and when you guys merged services, you know, in the past and stuff, it was nice to see that all the charts that I was used to watching transitioned over. So you're my number one source that I go to for some of my sentiment data, and it's always nicely formatted. And every time I listen to you, I see new things that you can present or look at with the data and different sorting and stuff. So I always learn something from you too.
All right.
I'm going to just jump right in here and
I got to get your screen now. Can't see it yet.
You can't see it yet. Let's see.
Got to do that share.
Okay, let's see here. Where am I going for this share here? I've got you are viewing stock screen. View options. Let's see here. I just need to find the controls. Aha.
Yeah, there they are. And let's see.
You popped it up there for me before.
I know, and I'm still not seeing.
Well,
yeah, just hit that share button and then click on one of the screens there for you.
Yes, I needed to get that share button back, and we are sharing. Yay.
All right. There you go.
So
yeah,
what
we can get that
today,
a little bigger.
I am just like when I mentioned in my Trading Sardines book, you know, that we overcomplicate things a lot of times. And early on, the first decade of my trading career, I learned how important it is to always consider three main things. And that was the sentiment readings, the monetary environment, and some momentum, basically technical structure. But momentum indicators. And these were the three variables that the Wall Street ELVS index from the good old days, Bob Nurock's ELVS index, really were comprised of. And I think I mentioned the success rate of that first decade of timing signals, and it was somewhere above 90% for market timing over a decade. So these are should be primary tools for a technician to consider. So right off the bat, though, I'm going to start off with some seasonals because this was stuff that I had mentioned on Twitter, and I just wanted to explain a little bit more about how you use seasonals, and you know, they should always be used as a secondary timing feature. It's not necessarily the basis for a trade. They should be used as confirming things or to give you confidence. And we had a seasonal long that started last week in the NASDAQ futures. And then on September 1st, we had a seasonal long that started in the Dow and the S&Ps. And this is a free trade strategy that Steve Moore Research Center puts out. So I wanted to highlight this for you here, the yellow that you can see on these charts. He always gives you a free spread trade, and in this case, it was primarily long the Australian dollar against the Swiss. And then also it shows this long seasonal window in the Dow. And this is important for several reasons. A, everybody tends to think of September as this horrible month. But the thing you have to know about seasonals is that they're very much a statistical type of piece of data. So, for example, if I were to look back over the past 20 years and see that over this window, this trade worked 85% of the time, that's a fairly low sample size. So on a walk forward basis, it means that it's going to work out about 66% of the time. So seasonals are not a fact, they're not a given. But they do show the behavior in previous years. Second, they're not timing sensitive in that there's nothing superior about the day of entry or the day of exit. It's just that here is this window of time that should show a positive expectation. So right now, for these first 2 weeks of September, we have a bias. It's a positive expectation. And Steve also provides the data for the previous years. So this is looking at the Dow mini, and you can see that basically buying around the start of September here and exiting in the middle of the month yielded a profitable window. It looks like 13 out of 15 years. So immediately it helps us correct this bias that we might have that September is a horrible month. And of course, the last 2 weeks of the month are not nearly quite as stellar. So that's what we have going on right now, just potential for a seasonal bias. And with that, you still need to monitor the markets one day at a time. Seasonals may make their profit peak in the middle of the seasonal window and then give back. So it's a confirming factor, and I would love to get Steve to do a show for you sometime on seasonals. He says he's too busy, so I have to just give my 2 cents worth. So let's move on, and what I'm going to do is I'm just going to show you, normally I don't start with the seasonals, but I felt that this was an important window that was unfolding right here. And for those of you that do follow a seasonal program, it's always a numbers game. So if you make 20 trades a month, expect, 12 to 15 to be profitable, and you can't put the emphasis on any individual one trade. But with that said, last month killed it on the seasonal portfolios, and this month is off to an excellent start as well, because you had plenty of opportunity to look at buying spots yesterday as well as last week, and so forth and so forth. So we're going to look at the seasonals, then we're going to start down with the sentiment, just some basic oscillator tools, momentum tools, market internals, global money flows, and leadership. And lastly, market structure, because no matter what we look at, be it sentiment or seasonals or market internals, as a technician, I always have to be mindful that price is first and foremost. So all these things are secondary things that might tell us that there's an overbought or oversold condition or too much cash on the sideline. But market structure is first and foremost, because that is how we define our risk, and that is how we define if there's a trend or perhaps support or resistance, as well as loss of momentum or increasing momentum. See, it's so simple. So moving on to sentiment, I love looking at put-call ratios. And what I do is I only use the equity put-call ratio. The reason being, sometimes if you look at things like the OEX put-call ratio, there could be a lot of additional arbitrage that we don't know about, hedging against ETFs or portfolios or other things. There's all different sorts of strategies that go on there. So to me, it's more important just to look at the pure equity put-call ratio. And it's easy to see right here in the middle of August, we had a pretty significant spike up in the equity put call ratio. Normally, this will give a lower reading than, say, for example, something that includes index data. So this is always a bit lower. And I love the way the fact with these charts, you can blow them up and see the fine detail that this actual peak actually happened about 1.5 weeks ago, when, of course, the market did that big nosebleed and bit of a bear trap in retrospect there. So right now you can see that we have a, if you want to call it a buy signal on the put call ratios, and we have not yet reached the lower end of the extreme. My theory for a lot of these market internal indicators is similar to Soros' law of reflexivity, going from one extreme to the other extreme, and we never quite stop too long in the middle of that equilibrium level. So right here, we are on a buy end. We still got plenty of gas to go. Moving on, I will like to look at the McClellan oscillator. I actually use a 10-period simple moving average of the advanced decline line, but everybody knows the McClellan oscillator. And I just wanted to give my 2 cents worth on using these types of breadth oscillators, or for that matter, any momentum oscillator. And the first rule of thumb is I never try to analyze it when you are in this chop trading range. You see, because what will happen is you'll start to get so many wiggles and jiggles that none of it becomes too meaningful. And we're not at an overbought or oversold level here. It's just doing a lot of wiggles and jiggles. So if it's a simple oscillator on a price bar chart, I'm usually mindful that we shouldn't be trying to look at it as a directional bias. On the other hand, when we use the smoothing of these momentum oscillators, and in this case, you can look at the summation index, which is a much broader thing. I know that there's several ways that people use this. The first is looking for the divergences in this, and you can see that's meaningful indeed. However, there's also another significant thing going on at work here. This is very long term. It doesn't mean it will play out. It does mean that there is some legitimate case, if you are a bull, in that this essentially did a prolonged ABC corrective wave feeling for this year. So from this point here, we've essentially consolidated sideways as this has done an ABC down. So I don't necessarily see that as a deterioration. I see that as a corrective feature from these divergences that have now corrected. So for me, we're very neutral here. It's not overbought, oversold. That's just my interpretation of that particular indicator. I do look at investors' intelligence, as well as this is the AAII reading, and it's easy to see that this showed a big push up in the bearish levels, which we needed to see, all right? And so in general, with sentiment indicators, when you see a high level of bearish reading, that tends to reflect that people are out of the market. So if people are bullish, it reflects the fact that they are invested and they're expressing their opinions, being bullish. They're expressing their positions that way. And likewise, when you see extremes in the bearish sentiment, it's telling you that people are out of the market, and generally there is cash on the sidelines ready to go back in. So that's my simplistic interpretation. Now, what's really interesting here, I don't have a chart up of the investors' intelligence readings, but that has not shown any increase in bearishness and has stayed pretty much at bullish levels for the past 6 months. By that, I mean people have not shown any fear of the market, despite all these China trade tweets and other extraneous things. So some might interpret that as a level of complacency. On the other hand, this AAI reading tends to fluctuate a bit more than the investor's intelligence. So for shorter term timing, it might be of more value. Moving on, I like to look at a few market internals. Somebody made note, I don't use the trend as much as I did once upon a time. The reason is that it very often gives distorted readings from Bank of America, which has an extremely large float and is a low-priced stock, so it can skew this quite a bit. But nonetheless, you can see the extreme trend reading that we had, and we also had a 90% down day if you're into monitoring those types of things. And as Walt Deemer so likely likes to point out, we then had two 80% up days, meaning that momentum had shifted back up. So you have a green light go after some of these extremes in the breadth, the up down volume days, the advancing declining issue days, and here the trend, of course, is the mother of ratio of all ratios, which is does have its own problems as well. I'll show you one of my secret timing indicators for intermediate timing, and it's my own invention, so I am proud of that. And if we look at the tick readings, this is the daily tick reading, the daily closing tick. One thing to keep in mind is that closing tick readings and the daily range of the ticks will vary from software program to software program. So for example, a trade station will give slightly different readings than the CQG, than other software providers. And the reason is ticks are not an exchange transmitted piece of data. So the data vendors actually need to compute their own. And the reason why the ranges or absolute readings can be different is they might have varying sizes to the database that they are computing the ticks on, which is if the stock is on an uptick or a downtick. That was a long-winded explanation. Suffice to say that they will all look the same, give the same shape once we do moving averages of them or some other work. And in this case, I wanted to show a 10-period moving average of the tick highs and a 10-period moving average of the tick lows. And what I have found is that when this gets stretched very wide like this, and our 5-period moving average of the closing tick pulls down low, that is a screaming buy signal. So you can see here, what does this mean when we have a 10-period moving average of the tick highs getting so overbought, if you want to use that word, it's not correct, and vice versa, the downside, the 10-period moving average of the tick low for the day, this is very extreme. Well, let me tell you what it means. It means that ticks are highly correlated to the market breadth. And what we see at market bottoms is a lot of volatility, unlike market tops where we get a lot of complacency and this contracts. So on the flip side of the coin, you can see right here in the middle of the chart, this big contraction in the daily range of the ticks. And lo and behold, it was a significant market top. And of course, that complacency manifested itself in numerous other ways, such as volatility indices and so forth. But this was a stellar example of a bottom made from these extreme stretched and volatility that had a bullish bias. So we'll see how much that gives us. You can see the last time we had a significant widening of the ranges was right here. And likewise, right here, we had some significant widening of ranges. And once again, this is a cyclical thing we see with the volatility back to overshooting in one direction and then overshooting in the other direction. So this has plenty of room to narrow again into year end, actually. Moving on, let's look at the global money flows. I'll always start with the daily charts, and I have a grid that actually has 25 markets, and I just picked 9 of them here because we have such a correlation now on a global money flow basis. Obviously, everybody's looking at the credit markets, and I know that some traders were confused with the bonds dropping below 2%, our 30-year, and there's only one thing to remember, one word, and that is TINA. TINA. There is no alternative. So in other words, it was the last place that you could go for some type of yield, regardless of how our economy was chugging along. So if we look here, we can see the same type of game that we play with stocks in terms of relative strength and relative weakness. And obviously, the Canadian ETF has been one of the stronger ones, right? Unlike China, which was one of the weaker ones. And the momentum, this USA Momentum ETF, was probably the all-time strongest here. So in general, sometimes we can see, are there bull or bear flags? Are there wedges? Are there momentum divergences? And it just gives us an overall feel. Yeah, some of these are pretty oversold. They're not stellar instances of a glamorous chart formation that gives you confidence to the long side. But let's jump out a little bit and look at the weekly charts. And you can still make a case on many of these. For example, Brazil, we're at the lower end of a channel. So we still see a pattern of lower highs, higher lows and higher highs. And nothing's really making ugly lows on these weekly charts. They could just be deemed corrective environment. On the other hand, there's nothing that's necessarily knocking our socks off either. But I like to look at this grid, and when you see everything line up at once, it's like bingo. Lastly, I'll go to the ETFs where we can see where are the leadership. This is also on my grid. And just for kicks, with CQG, I can turn the inverse. So we see how the driver of this whole thing has been these lucrative, easy monetary conditions, crazy lucrative monetary conditions. And that has been our big driver. So then we're going to go down and we're going to look at leadership or non-leadership with some of these top stocks, the big cap stocks. And these are just all on weekly charts. And we start to see a little bit of a mixed picture in that Microsoft, of course, has been really steady. Apple, a little bit more questionable. So we had new highs in many factors like this. And it's, in other words, what we see is we're giving it everything we've got. The gas pedal is pressed to the metal here. We're feeding this market as much as we possibly can. So we want to see these things catch fire and turn back up again on the weekly charts, because when we take our foot off the gas pedal, what driver is going to be left after that? So these are all some background things. The seasonals are positive. The sentiment is positive. The McClellan oscillator, That's not overbought, oversold. It's not giving any screaming signals. You could make a case it's given some corrective movement over the last 6 months. Our tick reading is positive. Our trend gave a buy. It's already worked off of that buy, though, for the last 2 weeks. And our global environment is relatively lackluster. So we're trying to hold the rest of the world up by our bootstraps at this point. And we have a mixed bag when it comes to leadership. Now, let's get down to the coup de grace. And the coup de grace is market structure. So important. So I go by basic swing highs and swing lows because as technicians, that is how we define our trend. Are we making higher highs and higher lows? Are we putting in a loss of momentum or not? So what we can say big picture about our market structure with the S&P 500, because of course the small caps are a little bit different, is we are still in a clean uptrend on the weekly charts. We do not have a lower high. We only have a higher low still on the weekly charts. There's not yet any big warning sign here. And what we see with the daily chart is same thing. We are still in an uptrend of higher lows. We really would like to see this turn back up. You can see that this type of indicator is going to be dependent on the price action. So let's say at the end of the week, the S&Ps were up at 2960. You will see this little line here correct back and still be going up. Okay, so just be aware of that it can fluctuate. So we are still big picture in an uptrend. We do not want to see this turn into a lower high. In order for it to turn into a lower high, we would really need to come back down more or poke up and fail, what they call a classic bull trap. And we do not have that yet. And lastly, this is the main thing that a lot of people have rested their bearish case on, as Erin pointed out, the fact that the small caps are not performing. And here was the saying that I was taught when I was a newbie on the trading floor in the 80s. And that was that the generals probe, but you need to have the army follow, or else the generals can get slaughtered. All right, so what that means is that our generals are those Microsofts and the Facebooks and the FANGs and some of these stronger shares, but we really need to have the small caps kick in, the broad market, because I don't think the leadership is sustainable for an extended period of time without lifting up some of these broader market indices. So big picture, we still have an uptrend in the small caps on the weekly because we have, here's our low. It would be trouble if we took out that low. So this is just a consolidation here. The bulls would like to see this turn back up. Of course, what the bulls want, the market is not always so accommodating. And this is the worrisome thing here, in that you have this ABC down on the daily charts, and this really needs to get a little match lit underneath it. Now on the plus side, you did have a gorgeous little bear trap there. I like it when you see that. Look below and you come back into the range. When that happens, I like to look for the middle of the range as the initial target for the trade. So these small cap shares would be alongside bias on my model, looking for the middle of the range. And if we can take that out, then you get the push back to the upper end of the range. And that is many steps ahead of us that we just can't go there. Now, I just wanted to take the time to show a couple more things that were of interest yesterday that I like to look at. I am very much a price-based person, so I operate off of swing highs, swing lows, and drum roll, gaps. Okay, so we have had lots of gaps the last month, as you can attest to. I am going to switch over just to some livestock charts and show some fun trades that may or may not catch fire here. First of all, yesterday when that market was selling down and when we were filling a gap to the downside, when I look at relative strength, we can look at it certain ways. We can look at it in terms of gaps. We can look at it in terms of swing highs and swing lows. And I think I'm running out of time, but I'm just going to go through this really quickly. IBM failed to close its gap. So if you like trading stocks, that is a superior buy signal when something trades into the gap and it fails to close it and it comes back up. Now, granted, it is not setting the world on fire today, but yesterday, that's what I was doing. I was putting on I was putting up a display of all the stocks where we traded partially into the gap, but failed to fill it because those were signs of strength in my book. Facebook did a similar thing. It actually failed to close that by just a few ticks, and it didn't close up as nicely as IBM, but you can see it's got a little bit of a fire under it right here. Now, this one is not setting the world on fire, Microsoft, but it is the big cap one that I like to follow. It's not going to be a high beta type of play, but it's always important for me to see that, again, it tested down and closed back up. So that was compelling. So lastly, when we look at true relative strength leaders, we're going to see a couple things. Visa. I think that the financials are really important. If the drop in these yields has stopped going down, we'll probably consolidate sideways for a while, but it might give a little bit of a lift to the financials. I was hoping that would give a little bit more lift to the small cap indices like the Russell, because that actually has a significant amount of financials in it. But just check out this Visa. When the market was looking kind of dicey down there 2 weeks ago, I didn't see anything so nasty about this. It looks pretty good. Same thing with the CME. Now, of course, this is in part based on volume if we look at this, but this is just classic relative strength work. When you see the market flush down, as we did 2-3 weeks ago, you still saw plenty of shares making new highs. Of course, this benefits from the increase in volume. And it's sort of an esoteric, weird list of stocks because you can see there's still a play out there for anything that generates some type of yield, since this is basically a utility stock. And then last but not least, we still have to go shopping somewhere, don't we? So this was one of my favorite plays when the market's a little bit soft and you get that pullback beneath that 5-period simple moving average after you've had a momentum spike is a superior buy signal that you can hold for 1, 2, 3, even 5 days, even 10 days. So that concludes my models that I wanted to show you today. To sum up, a little seasonal, sentimental, market internals, global stuff, what is the driver here? It was monetary conditions for sure, being very accommodating. And then we go down to our market structure and see that the weeklies are still in a structural uptrend with no lower high yet. And then we can go down to our market selection. What are we going to trade? All right, that's it.
Excellent. That was absolutely fabulous. I have to say, I was pretty excited about CME and Southern being on your list to look at. I actually own both of those, so
There you go.
I'm pretty happy with them, that's for sure. But yeah, it's been absolutely fabulous. We are out of time, but your website again is
lindarashke.net, and go there and read the first chapter of my book, because if you are a market technician, you will definitely appreciate the advanced reviews, all tongue in cheek.
Yes, absolutely. I loved it. All right. Well, thanks again, and hope you come back here another time soon.
Thanks for having me.
Absolutely. All right. So it's time to do the 10 and 10. And I thought that I would do it in ACP. So I know the first symbol was micron. So I'm just going to show you how easy it is to go ahead and analyze and give you a look at how to annotate 10 charts in 10 minutes. But I think because we gave Linda some extra time, because of course we all wanted to hear her, we might go ahead and just do 5 and 5. But if I have time, I'll do more than that. So micron is our first one to look at. I'm really happy with the look of this particular stock right now. Notice that we got that breakout here above the tops back in April and in August. Nice big move, gap up. Maybe we'll see, like what Linda had been talking about, that gap up, maybe a little bit of a pullback, but no closure of the gap. Excuse me. And so that, I think that looks pretty good there for Micron. But one of the things I really would point out is this lovely PMO right here. We're looking at a nice turn to the upside above that zero line, and we do have the crossover buy signal right now. So I think that Micron looks pretty good. Obviously, it's going to be a test as to whether it will get over that resistance from July, but I think that move, that push to the upside is very encouraging. All right, next up.
Erin, next up is VEEV, that's Viva Systems.
All right, thank you, Rachel. All right. Well, first of all, of course, I have the PMO highlighted right here, but I have to say, little bit of an issue here when you look at the fact that we had not only a top here, it was just above that zero line, but it topped out. That fake out buy signal came in, and now we're looking at a PMO sell signal again. So kind of a fake out move here. I guess really what I would look at as a positive at this point is the fact that we've held this area of support here at about 154.40. Look to see if it's going to keep that area of support. If it breaks down, and I don't know who requested this, and I can't give financial advice exactly, but if it dropped below that area of support, I'd be a little concerned that it would be heading down here to close that gap. And also, as you can see, what looks like could be forming a little bit of an odd one, but a possible head and shoulders is being formed right now. So this area of support, very, very important for Viva Systems.
Okay, next up is easy. It's Roku, ROKU.
All right. This was in our top 10, I know, on our dashboard. Really great movement here. I mean, how do you argue with what's happened with Roku? I have to say I was a little bit surprised because I had been watching this and I saw this double top forming. Technology has not been necessarily the best place to be, or comm services. So I was really thinking we were looking at a double top here. But when we gapped up right in there, actually, I'll just use a little rectangle here. When we gapped up here, I think that was really important. And we got the gap and it continued higher. We got the pullback, so we had this nice flag formation and a steady move to the upside. And now we're looking at another move, breakout move. What I would note is that the PMO, while you could consider it overbought, spot, we've seen it reach much higher readings. So if you want to take this out, you can do this and get a picture of what the normal range typically is. Of course, we don't have that much data on Roku, but typically you are seeing that balance here between, it looks like the 12 and 12 area, but you could actually see a PMO get higher than this. I think it looks great. I would just, at this point, maybe a trailing stop because it is in this parabolic move right here. So that'd be something to consider.
Okay, and next up is Nike, NKE.
All right. Oh, of course, I'm trying to spell Nike. All right, so I'm looking at this one. It looks like it's on a nice move to the upside here. I would be paying attention to the fact we did get that buy signal on the PMO, so momentum still looks good. Let's go ahead and focus a little bit here on what's going on with the OBV. And I would note the fact that we are seeing those rising bottoms on the OBV. You can even see the scooters is making a nice little rise as well, and that goes right there in conjunction with that move to the upside. This is kind of what I was thinking about as far as the S&P 500 goes, is we have this sort of a ascending triangle. So I would be watching to see if we get that break. Well, we got the breakout here on Nike, and the expectation honestly is a move the size of the back of this triangle. So we should see it test those highs that we had back in April and July.
Okay, and last one is netease.com, and that's NTES.
That's right, NetEase. All right. Wow, look at that nice breakout there. I've got the trend line tool. I'm looking right here. The first thing I'm noting is a flag formation that we got right here off of that move. And now we get this beautiful breakout. Let's look at the PMO just a little more closely. Look at this. It's not at all overbought. That means we could see that momentum continue to rise. The question now is whether that overhead resistance will be the stopping point, but we made it above this area of overhead resistance. I just don't see any reason why we wouldn't see it test those highs back here from April, May. So with that being a rising flag, you're supposed to expect the move to be as tall as the flagpole. So it looks like NetEase has a long way to go to the upside. So I don't know if I'd necessarily be buying it here, but I don't see, I would certainly not be selling it at this point. Really looks good. All right, and that is your 10 and 10. Those are the symbols that we just went over. We have just a little bit of time. I thought I would, let's go ahead and maybe look at that poll. And it appears, as I'm looking at it on my screen, is that the defensive sectors, everybody believes that they will still be our top performers at the end of September, which I think is very interesting. I have to say that my answer was yes. I do believe we're going to still see that. The market is still chopping around. I'm hoping that we'll see a move to that upside. That we'll get that swing and start seeing movement in those more aggressive sectors. So that's something that I am considering right now. I'm going to go ahead and share my screen. Can I share my screen real quick? You know what? I'm not going to. We don't have enough time. Oh, actually, let's go ahead and try. All right. So I just wanted to look real quickly at the let's go back here. Let's go to charts and tools. We're going to look at the sector summary really quickly, see what's going on out there. Currently, we do see the movement. The leaders are comm services, energy, interestingly, and technology. So we're starting to see a little bit of a resurgence on an intraday look. And as far as what's going on, as far as the months, there you go. You can see these are the top three by a long shot, quite a bit. So I suspect we will continue to see leadership there unless we do get that breakout and see some improvement maybe in those aggressive sectors where we're going to look for the market to move much higher. All right, well, it's been a lot of fun. It's kind of lonesome without Tom here, but we did have an excellent guest. You can see on our upcoming schedule tomorrow, I'll have Bruce Fraser, and he will be subbing and with me for the entire program. So you'll want to come back and watch that. I do want to thank all of you for being with us today. Do remember to complete that survey as you exit. We do love to get that feedback. Have a great afternoon, everybody. And I hope I'll see you back tomorrow. Happy trading.